So what we're going to talk about now is in the last section of the textbook. It's financial forecasting using the percent of sales method. And basically what this method does is it prepares a pro forma set of financial statements. And pro forma financial statements are used for a lot of different circumstances. Companies often do them to look at different choices they may need to make with product lines, or they might use them for different events they think might happen. There's some kind of economic uncertainty, or if they want to do a large sale of stock, a large offering of stock. There's many reasons why a company may choose to do pro forma financials. In this example here, we're going to actually do them to project what kind of external financing we might need. So are we going to need to take out an additional loan from a bank, or possibly are we going to need to sell additional stock? So this is what this particular exercise is going to walk us through. So the first thing we do when we're trying to create pro forma financials is that we project what our sales are going to be. So in our example, we're assuming that the company's already gone through that and they forecast or budgeted what their sales are going to be. Step 2 is looking at additional variables such as expenses, because basically we want to be able to get to net income. So again, we're going to assume that the company's already gone through all the steps to get a forecasted net income statement. The third step we need to do is estimate the level of investments that we need to support these sales. So do we have adequate equipment to support our estimated sales? Do we maybe need to upgrade equipment, buy additional equipment, purchase any other assets in order to meet our sales number? Because if we do, that's going to be an additional financing need. We're going to have to come up with the money to purchase those additional assets. So this is also an important part of the exercise. And again, in this example, we're assuming that these first three steps have already been completed by this company. What we're going to be walking through is calculating the firm's financing needs following these 5 steps. So if we look at our example here, this is from the textbook, the same example as the textbook. We're given this information. Our sales for 2022 are 20 million. Remember that this financial statement is expressed in millions of dollars. So 2022 sales are 20 million. And then the company's gone through the exercise of projecting their sales already. They've already done a sales budget. So they know 2023 sales will be 24 million. They've also gone through the exercise of calculating what all their expenses will be. So they know that their net income will be 5% of sales. The other piece of information that we need to do the pro forma balance sheet is the dividend payout ratio. And you may remember this from financial accounting, but the dividend payout ratio is just the total dividends that are paid to shareholders as a percentage of net income. Let's go ahead and work through this. Our first column here is our current year. The only change I did make from the textbook is I labeled this as 2022. So this is our current year, and this is our projected year. So you're given this information already in the problem. We've got our total sales, and then starting here, we've got our balance sheet. So these are our assets. Our current assets are 2 million. Our fixed assets, remember these are things like equipment, buildings, could be land, long-term assets, are 4 million. So this is just a sum of those two. 6 million are our total assets. Our liabilities, our current liabilities, this would include things like accounts payable, liabilities that need to be paid in the next year, are 2 million. Long-term, these would be our loans possibly, 2.5 million. So this is just the sum of our total liabilities, which is 4.5 million. And then we've got our stockholders' equity section. So we've got common stock, paid in capital, and retained earnings. So our total stockholders' equity is $1.5 million. And if you add up our liabilities and our stockholders' equity, this 4.5 million plus this 1.5 million, we get a total of 6 million for our stockholders' equity. And remembering the accounting equation that assets need to equal liabilities plus stockholders' equity, these two numbers should both be the same. And I've got a little formula down here that calculates the difference. And sure enough, those two numbers there is no difference because they are the same. So for those particular balance sheet items that are greatly affected by sales, we're going to express those as a percentage of sales. So our current assets, where our account receivables are, those are affected by sales. Fixed assets, equipment, that's going to be affected by sales. Current liabilities has accounts payable in it, so that will be affected by how much we produce and sell. Long-term debt is not necessarily affected by sales because we may or may not need to borrow more to produce these sales. That's the purpose of this exercise. Common stock and paid-in capital won't change with sales unless we decide to sell more common stock. So that, again, if we need more financing, we may sell more stock, or we could decide to buy stock back. Those would be the only things that would change that balance. Retained earnings, of course, will be affected by sales, but that's not going to be so easy to calculate as a percentage of sales because we need to think about dividends as well. So that'll be step 4 of our exercise that we're going to walk through, is calculating what our retained earnings will be. So let's walk through how these figures were actually calculated. So these figures that we're going to be able to set as a percentage of sales, we're going to take our assets of 2 million and divide our sales of 20 million. So I'll pop my calculator up there just for purposes of exercise. Right, we're taking our 2 million in our assets and we're setting that as a percentage of sales. So we're dividing by our sales, that's our denominator, and we're getting 10%. So that's where I got that 10% from. Fixed assets, we're going to set our fixed asset as a percentage of sales. So we're going to take this 4 million and divide by 20 million. So that's where we got our 20% from. And then our current liabilities, that's 2 million. So 2 million divided by our sales of 20 million, that gets us 10%. So our liabilities are 10% of our sales. We're setting our sales equal to 100%. So now that we've got our percentages here, let's use those in the following year. So to do the pro forma balance sheet, we assume that this percentage holds true in 2024. So if our current assets were 20% of our sales in 2022, then what we need to do here is we actually need to use that percentage and multiply it by what the sales are in 2023. So if I do that, I've got sales of 24 million, and I'm going to multiply by 10%. That means that my current assets in 2023 should be 2.4 million. What I'm doing again is I'm taking the sales figure and I'm multiplying by these percentages. I'm wanting to keep these percentages consistent based on what my sales are. So for fixed assets, I'm going to take my 24 million sales, multiply by 20%. That's going to give me my 4.8 million. And this adds up my two assets. And then my last figure that I'm going to set as a percentage of sales are my liabilities. So that's going to be 24 million multiplied by 10%. It's going to give me 2.4 million. These other numbers that aren't affected by sales, I'm just going to keep the same. So the 2.5 again for my long-term debt, 0.1 million for my common stock, 0.2 million for my paid-in capital. Now to calculate retained earnings, that's the last figure we're going to need for our balance sheet. We're actually going to do a little bit of a formula here. You may remember this from financial accounting. The way to get our ending balance in retained earnings is just to take the prior year's ending balance, which of course is the current year's beginning balance, and we're going to add in net income and subtract dividends. So that's what this formula is down here. 2023 retained earnings, our ending 2022 retained earnings, plus our net income, less our dividends that we pay out. So the first thing we need is we aren't actually given a dollar amount for our net income. In the real world, when they go through this exercise, they're actually going to come back and give you a dollar figure for your net income. But in this particular problem, we were just given that it should be 5% of sales. So to figure out what that net income needs to be, we're going to multiply our sales by 5%. So we've got our 24 million. This is our projected sales for 2023. Got our 24 million, and we're going to multiply that by 5%. And that's going to give us a projected net income of 1.2 million for 2023. Okay. The other piece of information is we need to figure out what our cash dividends will be in 2023. So to get that, we just take our 2023 net income, multiply that by the dividend payout ratio, which we were given up here, and that'll give us our dividend payout. So net income of 1.2 million multiplied by 40%, gives us a dividend payout of 0.48 million or 480,000. So if we put all those pieces of information together, our beginning retained earnings of 1.2 million, our net income of 1.2 million, subtract out our dividends of 480,000, that's going to leave us with an ending balance of 1.92 million in retained earnings. So that's the figure I'm going to plug in right here. So now I've got my balance sheet complete. I've got total assets of 7.2 million, and I've added up my liabilities of 4.9 and my stockholders' equity of 2.22, and that gives me total liabilities and stockholders' equity of 7.12 million. Now notice that these two figures don't equal each other, and that shows you the amount of external financing that we'll need. So to support sales of 24 million, we're going to need 80,000 in external financing. So 0.08 million is 80,000. So we may get that in taking out a loan. We may get that by adding to our long-term debt, or we may sell more stock on the stock exchange. So we may get that by issuing additional shares of stock. But at this point, we know that's what we need to figure out is how are we going to come up with an additional $80,000.